Good afternoon, everyone. This is Henry, and as we get into tonight's free video, I wanted to begin by thanking those of you that are following these reviews through YouTube and that are leaving likes and comments and actually interacting in the conversation, because I really do try to make them worth your while. And like anything that you want to really spend time to learn, it's going to take time to see the concepts play out. Now, I begin with that because I can show you that here on this exactly 2 weeks ago, right, the video that we were discussing on October 13th, if you want a foundation, you can go back and use this, but it's just such a great thing to learn in understanding when the market may be leaning too far in one direction. You'll remember that as we were getting through this is where we saw that inflation data hit and really just drilled the market. 1 hour before the cash session opens, sells off in a very extreme way. But then almost, right the moment that the markets open, the bottom is made and you see a very significant rally. Now, why did we see that? I believe that you can argue that that came through because of the reading that was made in the put-call ratio, right? If you see this bar here, this is the one in discussion, and this was made on 10/13. So if we kind of size this up and look at it in the same way, you can see that the opening was a big down move, sentiment about as bearish as it could be. And from there, the market had nothing to do but to rally. Now, over the course of the past 3 days, and what we discussed in that foundation video is that you could be looking for just the opposite to trigger you in the opposing direction. That when extremes are made in the opposing end, well, then the market is a little bit too complacent, a little bit too call happy, right? Everyone buying calls, and that makes it very difficult for things to continue to push higher. So how do you describe, or how do you look at what is overbought and oversold? Well, here in the put call chart, I'm going to go to my studies and I'm going to edit. These are proprietary, but the concept is simple, so stick with me. As we look at the high of the low bar, I'm going to edit this to being 55, because 55 is a Fibonacci number, and there are many ways of looking at this. But again, we want to measure extremes, and we want to measure extremes against itself, right? So the 55 is a very far-reaching back period, and when you see that on that print, the put-call ratio made a fresh 55 bar low, that tells you that there is more call buying going on than there has been in the past 55 daily bars. If we're to assume that most of that call buying is being done by retail, again, it just makes it a very difficult move to continue to see higher. I believe that speaks to the waning action you have seen from there. What presumably will be a gap lower tomorrow on extremely disappointing Amazon numbers, Apple, basically flat after the report, down a touch. But again, this is how you can use that sentiment to know, one, when there are too many bears in the market, we're usually going to see upside pressure. And then when you get on the flip side of that extreme, that's the time for things to start to top out. So I hope you find the review helpful. Have a great rest of your evening, and we'll see you in the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful, and if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.